Hi, everybody, and welcome back to our last appendix in Chapter 9, Appendix 9 Bravo. And here we're going to take a look at standard cost systems and a financial reporting perspective of that using Microsoft Excel, my favorite software package. Okay, so here we'll prepare an income statement using a standard cost system. And of course, we use our normal accounting equation where we have our assets equaling liabilities plus stockholders' equity. Now, for retained earnings, we're going to use the following equation. The ending balance of retained earnings is going to be equal to the beginning balance plus net operating income minus dividends. Okay, very standard. All right, the four key assumptions here are, number one, work in process and finished goods are carried at standard cost. That's pretty much true for any manufacturing company. Two, clearing accounts begin and end with zero balances. Number three, only cash, raw materials, work in process, finished goods, property, plant, and equipment, and net of accumulated depreciation and retained earnings are used here. Number four, positive numbers increase accounts, negative numbers decrease accounts. Okay, so an example here is using the Dillon Corporation, and it produces only one product and uses a standard cost system for internal management reporting and financial reporting. Dillon uses a plant-wide predetermined overhead rate based on direct labor hours. Very common. Number three bullet point, all of the company's manufacturing overhead is fixed. Okay, and number four bullet point, the predetermined overhead rate is based on fixed overhead of $1,875,000 and 75,000 direct labor hours, producing a rate of $25 per direct labor hour as the predetermined overhead rate, $25 per hour. Now, its beginning balance sheet looks like this. We have our assets over here. You'll notice that it's using Excel spreadsheet here. We have cash, raw materials, finished goods inventory, property, plant, and equipment, net, meaning, of course, accumulated depreciation has been deducted, and then our total assets and our liabilities and equity, retained earnings, and total liabilities and equity. Notice this is a partial balance sheet with dollars and thousands. Okay, that's the beginning. So here we have direct materials. They used 4.2 pounds as the standard quantity, and direct labor, 0.75 hours, and fixed manufacturing overhead, the same as direct labor here, 0.75 hours. So our standard price is $5 for direct materials per pound, $15 for direct labor, and $25 per hour of fixed manufacturing overhead. So the total standard cost per unit is going to be $21, 4.2 pounds times $5. Direct labor, 0.75 hours times $15 per hour, $11.25. And finally, fixed manufacturing overhead of $25 times 0.75 hours. And that totals $51 standard cost per unit. Okay, during the year, Dylan completed the following transaction. It purchases 380,000 pounds of raw materials for cash at $4.75 per pound. Number two, it adds 365,000 pounds of raw material to work in process to produce 88,000 units. And number three, it assigns direct labor costs to work in process. The direct laborers who were paid in cash worked 72,000 hours, here actual, at an average cost of $14.50 per hour to manufacture that 88,000 units, actual. Okay. Then we apply fixed overhead to work in process using the predetermined overhead rate multiplied by the number of labor hours allowed to manufacture 88,000 units. The actual fixed overhead costs for the year were $1,750,000. Of that total, $900,000 was related to items such as insurance, utilities, and indirect labor salaries that were all paid in cash, and $850,000 related to depreciation of manufacturing equipment. Number five, we transferred all 88,000 units from work in process to finished goods. Number six, we sold for cash 85,000 units to customers at a price of $62 per unit. And number seven, we transferred the standard cost associated with the 85,000 units sold from finished goods to the cost of goods sold. And then number eight, we paid $450,000 of selling and administrative expenses. And number nine, we closed all standard cost variances to the cost of goods sold. Okay, now we set up a summary of these transactions here. Here's our cash, raw materials, finished goods. These are dollars and thousands, and our retained earnings. Okay, that's the beginning of the year. So now we're going to compute our material cost variance, which we had in our previous Chapter 9 calculations. And here, the material price variance shown in equation form is the actual quantity times the actual price minus the standard price. Okay, the material price, therefore, is going to be 380,000 pounds. That's the actual quantity times the difference between the actual price and the standard price. So here we have a nice favorable variance of $95,000 because we purchased the material for less than the standard. Now the quantity variance, we're going to take in equation form, we're going to take the standard price times the actual quantity minus the standard quantity. And when we do that, the material quantity variance will be $5 per pound times 365,000 minus 369,600. Okay, and that gives us a material quantity variance of $23,000 favorable. Our labor rate variance is going to be similarly calculated. We're going to take the actual hours times the actual rate minus the standard rate. So here that's going to be 72,000 hours, and we did it for $14.50. Standard was $15. So our labor rate variance is going to be 36,000 favorable. However, our labor efficiency variance we're going to calculate that based on the standard rate times the actual hours minus the standard hours. So here, our standard rate of $15 per unit, and we take the 72,000 minus the 66,000 standard. That results in an unfavorable labor efficiency variance of $90,000. Okay, then as we calculate our overhead, all of overhead was fixed, you'll remember. So we have a fixed overhead budget variance. We're going to take the fixed overhead budget variance by calculating actual fixed overhead minus budget fixed overhead. And that number was $1,750,000 minus what was allowed, which was $1,875,000, generating $125,000 favorable fixed overhead budget variance. And our fixed overhead volume variance, we had the budgeted fixed overhead minus the fixed overhead applied to work in process. So here, our fixed overhead volume variance is the budgeted fixed overhead minus that fixed overhead applied. That resulted in a fixed overhead volume variance of $225,000 unfavorable. Okay. So now if I put that all into this spreadsheet, I get something that looks like this. And here it all is. Here is our raw materials purchases and our material price variances, our material quantity variances, our labor rate variances, our labor efficiency variance, our fixed overhead budget variance, and our fixed overhead volume variance. So then you can see that we close this to retained earnings here of $36,000 unfavorable, or a subtraction from retained earnings. Okay, and that generates ending retained earnings here of, I'll call it 7,863. Of course, these dollars are in thousands. Okay, so you can see we had cash, we had raw materials purchases, we had work in process, which is zero as we moved everything to work to finished goods, and away we go, recording those transactions. Now, if we prepare the income statement, we can come up with a notice that our cost of goods sold is reported at standard, right here, reported at standard, and the total variance adjustments are added to this amount here, because in general they were unfavorable. Okay, so we get the adjusted cost of goods sold of $4,371. And so that sales was based, of course, on what we sold the product for. And then our gross margin is the difference between cost of goods sold and sales. And then we back out sales and administrative expenses, leaving us with our net operating income. And that ends this video on using Excel for generating an income statement. And when we return, we'll move on to Chapter 10. Until that time, bye for now.